Good afternoon and welcome. My name is Kevin Igo, Director of PFP. I'm pleased to welcome you all today to our webinar concerning tax investigations in the digital age. It's very much a very hot topic at the moment. This is one of a number of monthly webinars that we produce at PFP for our member firms and selected guests. And I'm delighted today to introduce Dominic Arnold, who's Partner and Head of Tax Investigations at Moore Stephens. So firstly, welcome, Dominic.
Welcome, Kevin.
And firstly, perhaps you can give our listeners some background about yourself.
Thank you, Kevin. Yes, I'm Dominic Arnold. I've been leading the tax investigations practice at Moore Stephens for just over 5 years. Prior to that, I worked in a Big Four firm in their tax dispute team, and before that, 18 years as a tax inspector with HMRC.
Okay, thank you. So if anybody has any questions, please feel free to send them in the usual way in the questions box. Dominic has, as ever, said he'd like the more difficult questions, the better. And we will also be sending a copy of the slides out at the end.
Thank you, Kevin. So tax investigations in the digital age. Well, let's put that into context. When I joined the Inland Revenue in the late 1980s, the department had only just begun to use computers, and in fact, they did very little, and most of the work that was undertaken by the taxman was done in paper, and in fact, mostly in triplicate. Computers played a very small part in the way that investigations were selected and indeed worked. But if we fast forward 30 years or so to now, we find a landscape that's completely different. And at the heart of that is big data. And more importantly, how HMRC has placed it front and centre in its war against tax evasion and other non-compliance. I'll talk a little bit in a moment about the HMRC Connect system, the so-called snooper computer, and how this has revolutionised the way in which the taxman harnesses the huge amount of data which it has at its disposal. Global cooperation through automatic exchange of information is also bringing a veritable treasure trove of information to tax authorities across the world. And HMRC in the UK has wasted no time in using it to write to thousands of account holders who might have underpaid tax. A project which only a few years ago might have taken many months or even many years to complete is now taking only a few months under a fast-track process. We've also seen very recently the introduction of the trust register in the UK, and again that will provide a huge amount of information about trusts, about beneficiaries, etc., that wasn't previously available to the taxman. Data leaks have featured quite heavily in the last 12 months or so. We had the Panama Papers and more recently the Paradise Papers. And again, large amounts of information has been made available, not just to HMRC, but to tax authorities around the world. And the task of analysing this, again, becomes much more simpler with tools like Connect that HMRC have.
Early question from Tom concerning the trust register. He's asked, can you clarify exactly what is on that trust register? Who compiles it? Please.
Well, first of all, the responsibility for registering with HMRC is with the trustees. The amount of information to be provided is quite significant. Obviously, the obligation to register is linked to a UK tax liability of the trust. So that doesn't matter whether it's a UK trust or an offshore trust. If there is a liability to tax, then there is an obligation to register. The information that's required to be provided includes detail of the trust, the trustee, the beneficiaries, potentially the settlor, a really wide variety of information that needs to be provided.
Yeah, Andrew just seeks clarification on that. Could you explain how exactly you register?
So there is an online portal on the HMRC website, and that's used for the initial registration.
Okay, great, thanks.
So before we talk a little bit more about the future, let's just hop back very quickly to the past and the way that the revenue used to do or used to select tax investigation cases. It wasn't so long ago that tax inspectors actually looked at physical tax returns, but that's pretty much a thing of the past. They might look at, for businesses, the gross profit rates that were being returned. The problem with that often was that the benchmark figures for certain sectors or industries were often out of date, or they just didn't have enough information to properly benchmark figures. The revenue has always had an enormous amount of third-party data at its disposal, even going back a number of years. The biggest problem, of course, was bringing that together and utilising it to select cases. Foreign tax authority requests. In the past, these were always very difficult because HMRC would send off an application, normally under an exchange of information provision within a treaty, but very often those requests took many months, sometimes many years, to actually be acted upon. But the common reporting standard and the automatic reporting of bank accounts, of course, has changed all of that. In the days that we had local tax offices, tax inspectors might have known quite a lot about the businesses that they dealt with, but I'll come on in a minute to talking about the way that HMRC is drastically reducing its estate, so that's no longer really available to them. Similarly, in the past, tax inspectors might have gone and actually looked at businesses that they were thinking of investigating, but again, with the reduction of the number of people available and where they're located is making that more difficult. And let's face it, if you have Google Earth, you don't really need to get out of your seat too often. They collected a lot of information in the past on certain trades and certain sectors, but as I said before, this was often out of date, and it was more difficult for HMRC to pull this information from the limited tools that they had within, for example, the self-assessment system. We've had the internet, obviously, for a long time, but researching on the internet is notoriously random, and tax inspectors were only as good as their ability to use Google, etc. And one of the biggest issues in the past was the fact that HMRC would often investigate in silos, i.e. just deal with income tax, perhaps VAT, payroll, completely separately. And all this meant that in reality, choosing investigations, selecting them, was a manual, slow, and very expensive process. So how are things changing? Well, to answer that question, we have to look at HMRC's digital strategy. And at the heart of that is data and data-led risk and intelligence. It's no longer the case that investigations are selected purely on the gut feeling of an inspector. The majority of cases now are selected on pure, hard information and fact. And increasingly what we will see is investigations by inspectors who are sat at their desks, not necessarily going out to see businesses or to have meetings with businesses and their advisors. We will see more and more letters coming out from inspectors asking for information and conducting investigations from behind their desk. We already have an online disclosure, digital disclosure service. This is used, for example, for notifications for the Worldwide Disclosure Facility, and we can expect more and more disclosure services to be put online. This should actually read Making Tax Digital. That's really at the heart of the way that HMRC wants to interact with taxpayers going forwards, including personal tax accounts. So there is a one-stop shop for businesses and individuals with respect to their tax affairs. We can expect to see, I think, much more tax in real time. Historically, tax investigations will obviously be backward-looking. I think in the future what we will see is much more audit in real time. And as I said before, the reduction in the HMRC estate to just a small number of super offices will impact the way that the revenue investigates.
You mentioned the risk selection.
Yeah.
We have a question from George about the risk selection for unannounced visits. You mentioned cold hard data.
Yeah.
We recently had 4 HMRC unannounced visits on a client property on a Sunday. The final outcome was car depreciation was 8% and not 18%. So what sort of criteria do they have for risk selection for unannounced visits?
Well, I think, George, first of all, I share your experience of there being much more unannounced visits these days than there used to be. And in many cases, you're absolutely right. You sit back and you wonder why the inspection was unannounced, given the risk that the revenue have actually identified before they come out. I mean, very often the inspector might come unannounced if he thinks that, quite frankly, he'll catch the business owner on the hop. But of course, in reality, what often happens is they turn up and find that the business records aren't at the business premises, so no kind of inspection can take place anyway. And of course, business owners will naturally want their advisors to be present, during the inspection. So I don't think there are hard and fast rules about when inspectors should do unannounced visits, but it's certainly on the increase.
Okay. For Bill, does HMRC still use the completely random inquiry approach?
Well, of course, it's a difficult question to answer because they will never tell you that an inquiry is random. But I think there are bound to be some cases, but I can't remember, Kevin, the last time I saw one.
Yeah, I think it's less than 0.1% are actually random.
Yeah.
So if you're getting a pay-as-you-earn visit or a back visit or obviously an aspect inquiry, that's not going to be random.
No, it's normally
like your full inquiry.
Yeah, I mean, it's normally pretty obvious from the opening letter that the inquiry is risk focused. That either the revenue are quite clear as to why they're inquiring into the return, unless, as you say, Kevin, it's a full inquiry when arguably there's a greater chance that it's completely random.
George goes on about the 4 visits. There were 4 officers, not 4 officers.
Oh, right, okay.
But they interviewed the staff as well.
Yeah.
It's not really the subject of today's thing, but as a point of principle, they are not allowed to interview staff without permission, are they?
Well, absolutely, and it's very important that people understand what HMRC's rights are and the obligations of the taxpayer in this situation. Obviously, in terms of the inspection, HMRC do not have an automatic right of entry. They have the right to inspect, but if they're asked to leave the premises, they must do so immediately. And the other thing they're not allowed to do is search the premises unless they've got a warrant to do so.
Okay, thank you. Now, we've got a couple of quick questions about the trust thing, which I think we'll deal with before we go back.
Yeah.
The trust service is not going to be complete as trustees don't know about it. This is a comment by Gareth. Agents have to register for a new agent service account first.
Yes, correct, through the gateway, yeah.
And you make the comments, to shame HMRC can't even be bothered to transfer their own trust self-assessment data to date.
Well, I think it's commonly known and probably accepted by HMRC that this has all been done in a hurry, Kevin. The obligation to put the trust register in place ironically comes out of EU legislation. And I think in the summer the revenue realised that they needed to get quickly onto the job, but I think what it's meant is that we've got a rather rushed online service which they accept isn't perfect, and it won't be perfect.
Yeah, indeed.
So I mentioned a couple of times the HMRC office reorganisation going down from, over the next 10 years or so, 170 offices to just 13 proposed regional centres, which are shown red on this map. I think when I joined the revenue, probably the combined estate of the revenue and the customs and excise was probably nearer 400 to 450 offices. So what you see here is a vast reduction, not only in the number of people, but in the locations that HMRC are operating in. And you just stop to look at that and you think, well, if you're a business owner in Penzance, your nearest tax office is the one in Bristol, which probably looks close on a map, but I think it's something like 150 miles away. The east of England, you look at that and think, well, there's a vast swathe, albeit not densely populated, but there's still a very large geographical area there which will largely be served by a single office in Nottingham. So it's inevitable really that if you're going down to this number of offices, that you've got to use digital in order to work more effectively and more efficiently. So let's go and talk a little bit about the HMRC Connect system, the so-called Snooper computer. And that's what it looks like apparently, hopefully in a more complicated case than a straightforward one. Now, HMRC doesn't publish what information is in Connect, but we know that, for example, it includes data provided by card merchants, debit and credit card information, land registry information, the entire DVLA database, obviously details of UK and overseas bank accounts, local council taxes, details of previous investigations. More recently, they've added information on peer-to-peer lenders and online marketplaces. But it's also thought to include, rather worryingly, information on social media accounts and web browsing and email records. But what does it do with all that information? Well, at the back end of Connect, it uses the information to risk profile, interrogate large amounts of data that it receives. So there is a veritable army of data analysts that can use this information to look at trends, spot potential non-compliance cases, and use that to determine, for example, what sort of cases should be taken up for investigation. And then at the front end, so this is really when the risk analysis has been done and the profiling, and they begin to look at individual cases. The front end, the integrated compliance environment, is used by inspectors to collate data around their intended targets, and that could include information on relevant entities such as companies, trusts, partnerships or whatever might be available, so that they can package the case ready for an actual investigation.
Yeah, a quick question here from Alice. Risk selection. She's heard that HMRC never read the additional information box on tax returns, i.e. the white space box. Is this correct? And if so, what's the point of completing the white space box?
Well, I wouldn't necessarily agree that they never read it, because I've certainly worked on inquiries where the information on the white space has been a factor in the investigation being taken up. But on the second question, why bother? Well, I think the answer to that is relatively simple. It's because potentially that white space will be very valuable in limitation arguments later on. So if the revenue don't make an inquiry within the 12 months and then seek to discover or use their discovery powers, then what's in that white space could absolutely be critical to shutting them out of an assessment.
Going back to our pay-as-you-earn visit, quick question from Stephen. Do HMRC require permission to talk to staff in a pay-as-you-earn inspection? A client had one a few years ago. After checking the records at our office, they went off to visit the business premises and talked to all the staff.
Well, we have to recognise that when they're in a business, HMRC are obviously investigating that business or inspecting that business, and they are the first party in that situation. Employees are normally third parties, unless they're directors or the managers of the business. They're normally treated as third parties by the revenue. The bottom line is that inspectors should make it very clear to everybody that's in the business premises that they have no obligation whatsoever to be there or indeed to answer any questions. And it's just standard protocol that in these situations the inspectors should ask the business owners, the directors, for permission to speak to the staff.
Okay, thank you. I'm going back to Connect. Will HMRC get notified for every property sale on the land registry?
Yes. Yeah. There should be no reason why they're not. And of course, in due course, and I think the deadline for this is 2019. They're still, I think, persisting, Kevin, with the idea of automatic CGT notification within 30 days. I think that's still on the agenda. So, how successful is Connect? Here, a few facts and figures here. Well, it apparently contains over 22 billion lines of data, which is quite mind-boggling. And in a single year or so, between 14 and 15, there were over 12 million HMRC staff searches in relation to potential investigation cases. It can identify patterns, links and networks which might otherwise be impossible to stop. This has been particularly successful, Kevin, I think, where HMRC is looking at attacks on the tax system. In other words, organised criminals that may be setting up false self-assessment accounts with a view to actually stealing money directly from the tax system, VAT repayments or income tax repayments, etc., etc. And Connect has been very good establishing and trying to spot those links that before were very, very difficult to spot. There are nearly 600 million compliance documents in the system, mainly consisting of various types of tax returns, whether it be income tax, corporation tax, VAT, etc. And the cost to date of buying the system and maintaining it is said to be somewhere in the region of £100 million. Well, first of all, in terms of its impact, what HMRC has seen is a significant increase in hit rates, i.e. the number of inquiries that actually produce an additional tax shield. And I think, to be fair, Kevin, that's not a bad thing, because clearly people are getting their tax returns wrong. Now, it has to be said that the majority of that increase in hit rates is down to relatively small amounts of money, so where people haven't put bank interest on their account, or they might have had a bond mature and forgot to put that on their tax return. So although the hit rate has increased, the yield relating to that hit rate is not necessarily as much as you might think. But overall, HMRC say that they've recovered in excess of 3 billion in relation to Connect-related inquiries. About 80% of inquiries are currently generated by the system, and HMRC believe in the future that they ought to get that figure higher. The speed at which they select cases appears to be getting quicker, or so HMRC tell us, and I think that means that theoretically, if they're going to inquire into the return, we should see more inquiries coming through not long after the returns are filed, rather than what we've tended to see in the past, which is tax inspectors desperately trying to get their inquiry notices out before the 12-month deadline finishes, normally at the end of January. We're also seeing inquiries, particularly business inquiries, where HMRC is taking a more holistic view and looking at corporation tax, looking at VAT and PAYE, and trying to deal with them together rather than in silos. But one of the biggest, I think, impacts of Connect is the ability of HMRC to use the system for one-off data projects, where they suddenly come into possession of large amounts of data. The ability to quickly turn that round into a project and start investigations is much better than it used to be.
Okay, we have questions coming in. Over 80% of inquiries are through Connect. What about the rest? Does, for example, variations in the gross profit rate still increase the risk?
Yeah, I think gross profit rate in businesses is still a key risk factor. I think what HMRC have got now, though, through Connect is a much better understanding of the benchmarks for businesses. So before, the self-assessment system could be used to a certain extent to extract that data, but I think HMRC have got a much better idea now of what a typical business, you know, in that particular area of the country should be reporting in terms of a gross profit yield. In terms of the extra 20%, well, you've got things like the Fraud Investigation Service, who, although still have their cases packaged and developed through Connect, you know, they will be cases that are ultimately manually selected for investigation.
Question: how often is the Connect system incorrect?
Quite often, I think. It's you know, no system is perfect, and no set of data is perfect. And I've come across plenty of cases, particularly on bank account information, where it's a case of mistaken identity. I had a case a couple of weeks ago where the client relationship manager called me up about a client and said, "Oh, could you ask him about this bank loan that he's taken for several £1,000,000?" And I said, "Oh, right. Well, what do you want to know about that?" And they said, "Well, we think you know, that we got a withholding tax application in relation to the loan from the lender." Anyway, the bottom line was it was mistaken identity. It was simply a taxpayer with the same name, but the information had landed up, you know, on his account, so to speak. So yes, data can always be incorrect.
Is the data relating to both individuals and corporate entities?
Absolutely, yes, both.
We have from Navish. On the Connect system, does HMRC receive transactional information on bank accounts, or just the existence of bank accounts, or just interest on bank accounts?
Interest on bank accounts, the balances on the bank account, and not necessarily, it wouldn't ordinarily be the transactional data. The transactional data for businesses is largely the merchant data information, which we're seeing is actually one of the key factors now in case selection.
Chris, what about the protection of our data and the ICO and GDPR, etc.?
Well, obviously, data protection is a huge issue. We could probably spend a couple of hours talking about that.
I think generally that would help to be in the Treasury's or the government's interest. So
absolutely,
that,
yeah, that's what HMRC would normally claim.
How far back do you think the information goes?
What do you do? Any specific type of information?
Just that.
Well, if we take bank account data, it will go back many years. I don't think at the moment HMRC has necessarily cleansed any data whatsoever from the system. I can recall again a recent case where the inspector raised the fact that the client had an inquiry in 2001, and this information was held on Connect. They didn't have any information in relation to it other than the basic data that there was an investigation. So quite how relevant it was, I'm not convinced. But theoretically, the information will just build and build and build and build, and I don't think they will necessarily destroy any of it.
Do you know if Connect is linked to RTI?
I believe it is, yeah.
Yeah. Okay, great.
Okay. So far we've talked about the HMRC program in relation to digital and investigations, etc. But let's just pause for a moment and think about the trends that we're seeing in tax evasion and tax evaders themselves, because obviously in order to combat the greater ability of tax authorities to spot tax evasion, we're seeing also tax evaders going digital, so to speak. Not necessarily widespread in the UK, but it's unrealistic to think that it doesn't exist here. It's Phantonware and Zappers. And essentially, these are software or hardware devices that can be attached or embedded normally within electronic cash registers to manipulate data relating to transactions. in simple terms, can be used to rewrite the till on a data. So the ability or the scope for tax evasion using this software or these devices is absolutely huge. So what have tax authorities around the world that are affected by this been doing to try and combat what is seen as quite a significant and growing problem? Well, in the US, for example, primary legislation has been required in order to outlaw the physical possession of phantomware or zappers. And certain tax authorities have developed their own so-called fiscal control unit devices, so that these are attached to electronic cash registers, etc., to stop people using or to nullify the effect of phantomware and zappers. In certain countries, that's involved the automatic transmission of data from the FCU to the tax authority, either periodically or in some cases in real time. And some tax authorities have also managed to bring in remote access to these till systems. And in some cases, there have been some quite significant large prosecutions and serious fraud cases that have been prosecuted by the tax authorities. So just as a few examples around the world, Canada, for example, is expected to recover over $2 billion by 2018-2019 following the introduction of FCUs or sales recording modules. Sweden has already, in the last 7 years, connected over 135,000 cash registered to an FCU, and they believe that they've increased their tax revenues by in excess of 300 million euros. Similarly, in Hungary, again, their VAT revenues have increased 15% in the first year after they introduced the fiscal control units. Perhaps something that I see more in the UK than the phantomware or zappers is false invoicing. And that's normally in the context of VAT frauds, but not exclusively. I see quite a number of cases where the evasion of corporation tax or income tax is also happening. It's obviously a relatively simple device to suppress profits or reduce or reclaim VAT. And it's quite difficult to spot because HMRC will normally need to cross-check between the supplier and the customer in order to establish whether or not the invoice is bona fide or not. Mexico estimate that they've lost over 3 billion euros between 2007 and 2009 in relation to forged invoices, which is quite a significant number. And so similarly, the Slovak Republic in 2014-15 detected that they thought they were losing somewhere in the region of 500 million euros. And in reality, it's not too difficult to achieve, because with the internet, you know, evaders can go on there and very quickly get all the information they need. They can often get a sample invoice because companies, you know, sometimes put them online. VAT registration numbers are not difficult, so very quickly they can produce an invoice which looks absolutely pucker, and one which at first glance, if the revenue were looking at it, would pass muster.
A question from Sheila regarding the fiscal control unit devices. Yeah. Are they allowed to use the FCU without the trader's knowledge?
Well, HMRC haven't got an FCU device to my knowledge. If they did have one, I'm sure that they wouldn't be able to use it without the trader's knowledge. The trader would know that the device is going to be attached to the till.
Okay, thank you.
So what's the answer potentially on false invoicing? Well, in some countries, tax authorities mandated electronic invoicing, so that there is a much better ability to cross-check and to ensure that with an electronic signature, when they look at the document, they have a greater comfort that it's genuine. Certain countries are looking at an online verification system whereby traders can go online and actually ensure that their invoices are verified. So in the event of an HMRC or tax authority audit, they can prove before the audit that their invoicing is secure. Again, certain countries have looked at whether transfer of data in relation to purchases should be made periodically or real time. So in order for the tax authority to check more quickly whether the VAT reclaims, etc., or the deductions for these amounts can be made. In Mexico, a project there resulted in over 4 million micro businesses coming into the formal economy, and I think HMRC, for example, over recent years has targeted online traders, Kevin, quite successfully. They got a lot of information through Connect, looked through it, and they realised that a great number of people that were trading through online marketplaces weren't registered with HMRC, and you know that things like mandatory electronic invoicing will help them with that, but of course we don't really have that at the moment here. And of course no discussion about tax investigations is complete without talking about cash, because we know that cash is quite a significant issue in terms of tax evasion. I read a recent study that suggested that the Bank of England believed there is something like 59 billion of cash in the UK economy which is unaccounted for. Now a fair bit of that's probably under Kevin's bed, but putting that aside, the banks clearly don't like the fact that there's so much cash in the economy, A, because it's expensive to transact with, and also because they're not making any money while that cash is circulated in the economy and not within their systems. So in terms of approaches that other tax authorities have taken, and I think we may be seeing some of these coming into the UK at some point, limiting tax deductibility of cash payments, I think, is one way of discouraging businesses to transact large amounts in cash. Also potentially monitoring people's ATM withdrawals, and again Connect might be a system that is looked at in terms of that. Eliminating high denomination currency, we've seen that in India in the last year or so, and that's forced a huge number of people in India to go and get a bank account. I mean, we don't have that issue here, but clearly if the government were to think about eliminating the £50 note, maybe the £20 note, it's going to be very difficult for people to pay cash for their extension if they have to do it in fivers. So that's one thing the government is looking at. We know actively there was a call for evidence in the last year or so from HMRC about cash and its role in tax evasion. The government is keen, banks are very keen to encourage or potentially enforce the use of cashless payment systems, and again I think this is linked to in real terms, will we see the same amount of cash in our economies in the next 5, 10, 20 years? There's virtually nothing these days that you can't pay for using a card or a cashless payment system, a phone, online, or whatever it might be. But HMRC I think are looking at other options, including internet monitoring, looking at partnering with online platforms such as Airbnb to get the data into its systems so that it can target non-compliance. And for example, looking at the collection of more third-party information to identify distant sellers. This is a particular issue for the UK government in terms of online businesses that aren't paying VAT. There's very clear evidence that there is a lot of VAT not being paid on people that are trading with UK customers, selling them, and of course there's a competition issue to that as well, because people in the UK are at a disadvantage if they're trading and paying VAT here, and if people are allowed to set up online and not pay VAT, then that's quite a big problem to solve. So bringing all of that together, what are we going to see more of in the future? Well, of course, it's data, and it's data predominantly. Without that information, HMRC is really going to struggle to deliver what it's promised in terms of reducing the tax gap and bringing in additional compliance yield. It's going to be increasingly real-time, I think. Once HMRC has perfected or begun to perfect the flow of data and the way that it uses data for investigations, I think we're going to see more and more audits that look at much more recent periods than they have done in the past. I think we're going to see some fully automated inquiries. In other words, inquiries that are, generated by the system, worked by the system, and not necessarily with a large amount of human intervention. I talked before about the fact that we will see more and more investigations being dealt with from behind the desk. So letters, emails, although I think HMRC still struggles with email these days as a concept, but I think in the last couple of weeks, Kevin, they've introduced a new system for secure emails, so maybe that will get better. I have a fear that the inquiry regime that we have at the moment, HMRC might not think is fit for purpose going forward. This process of sending a notice before the inquiry begins, being tied down to certain limitation periods. I wonder whether this will get a big overhaul in the years to come, so that it becomes a much more straightforward kind of real-time situation. I wonder also whether, with the Making Tax Digital program, if the majority of businesses are forced into a situation where they've all got online apps or to manage their finances, their accounting system, the next logical step is for tax authorities to think, well, why can't we have access to that in a much more direct manner, rather than go through this process of requesting, getting the information, going out to the business premises, which is quite difficult if you're sitting in Bristol and you want to go out to a business in Penzance. Why not develop a system whereby you can get remote access to look at the information that you want?
Some questions here. You mentioned the overseas information exchange. What sort of information are overseas countries actually exchanging?
So under the Common Reporting Standard, the typical information that's provided is details of the balance on the account, interest accrued on the account, going back a number of years in most cases, and obviously details of the account holder. We're seeing actually quite a large number of what the revenue call nudge letters. So we know you've got this account in, and typically they actually say these countries, and would you like, and inviting taxpayers to self-assess. I've not got a problem, I have got a problem, I'm going to make a disclosure, etc.
Claire comments, I've seen a number of not exactly tax inquiries, but simply amending tax bills, saying we think you've had this benefit, therefore your tax bill is X. Is that something you think we can continue to or expect to see more of? And will it be extended perhaps to things like bank interest and all sorts of stuff that they have on Connect?
Well, I think this goes back to what I said about fully automated inquiries. I think we will see more of this, where it isn't really a dialogue. It feels sometimes that they just write to you and say, the information is X, we think that is a tax bill of Y, please pay up. I mean, thankfully at the moment, you know, taxpayers still have the full protection of their appeal rights, etc. But in terms of the investigation process, I think it feels to me in a lot of cases that HMRC doesn't have the patience. It's just a question of, we think this information is right, that produces a tax bill, pay it or dispute it.
So you mentioned the Bank of England and it's £50 billion worth of unknown cash.
Yes.
Where do they think this has come from? Do they think it's all, well, dirty money, or do they think, where do they think it's come from?
Well, I think they know where it came from. I think they printed it.
Yes,
there may have been a few dodgy £50 notes floating about, but what they believe is that this is cash that is being deliberately withheld from the banking system in order to facilitate not just tax evasion, but money laundering as well. So we don't want to pick on any particular sector, but you know, it's well known that in the construction industry generally there is a lot of cash floating about. I've come across lots of examples where, you know, people are prepared to pay 50,000, 100,000 in cash, you know, to have some building work done. And that's where, and once that cash gets into the hands of people that don't want to pay tax on it, the chances of it going into a bank account are quite limited. They'll go and use it for purchasing stock or having a holiday and put the rest under the bed or in the safe.
Okay. Does the HMRC have a threshold for VAT investigations?
Not to my knowledge, and I don't think it has a threshold for any investigation.
Mohammed, further comments. For example, if a client has not been able to declare £50 or 50 pence bank interest, will they come after this amount as well?
One would like to think, Mohammed, that for that amount of money, they won't. That there'll be some kind of sense check of an inquiry. But I have seen cases reported where amounts of those magnitude have resulted in inquiries.
We haven't touched on penalties, and we've got a couple of questions and comments today about how you think the penalty regime may be going to change in future. And a certain amount, this is going to be speculation, of course. And a few comments as to why HMRC are adding penalties automatically to investigations at the moment. Okay.
Well, I think there is a proposed change, isn't there, Kevin? Because they're now, I think, consulting on a points-based system, a bit like, you know, the totting up procedure on driving offences. I think that's being mooted as a potential next development. And I think that's in reaction to the fact that the HMRC are getting a lot of criticism for fining a lot of people fairly low amounts, and those people are finding it difficult to take those penalties and those appeals before the tribunal, because quite frankly the cost benefit just doesn't work. So I think that in reaction to that, HMRC realises it's got to try and do more to ensure that people are not unfairly treated. What was the other question?
So that was, does HMRC investigate all anomalies or just cherry pick due to a lack of resources?
Does HMRC investigate all anomalies or just cherry pick due to? Well, I think the latter. I think there is a lack of resources, undoubtedly, at HMRC. Having said that, it doesn't always pick the cases that you would think it would pick. So I don't think it's a question of picking the highest value cases or the lowest value cases. It can often feel very random, and the disappointing thing is there are a lot of inquiries that we handle where it is clear that the cost benefit to HMRC is just not there. They continue pursuing these cases even though on a reasonable basis they're already in a loss position because of the amount of time that they spent.
Now, PFP recently undertook a Freedom of Information request on penalties.
Yeah.
And in that, as a result of that, we were told by HMRC that the number of failure to take reasonable care penalties had decreased in the year.
Yeah.
15, 16 to 16, 17, I think it was. But the number of deliberate penalties and deliberate concealed penalties had shot up.
Yes.
Do you think that's because people are more guilty than ever, or do you think that's a hardening attitude by HMRC to penalty collection?
Yeah, and that's an easy question to answer for me, because it's a hardening, Kevin, because I think the default position the revenue takes in most scenarios now is that it's deliberate, unless you can convince them that it's not deliberate, that it's just carelessness or innocent of that. And I think that's regrettable, because I see many cases where at best the behaviour is failure to take reasonable care, and the other thing I see a lot, Kevin, is the fact that the revenue are being very difficult about agreeing suspensions for careless penalties. They seem to have an attitude that they simply don't want to give that one chance to the taxpayer.
Okay. Does HMRC always act on SAR reports for soccer?
The answer is no. This was subject to, in fact, 2 National Audit Office reviews in the last couple of years. The first review concluded that the revenue was absolutely hopeless in terms of dealing with suspicious activity reports, and told it to get its house in order. It came back, I think, a year, maybe up to a year later. There'd been some improvement, but there's still an enormous amount of reports that go uninvestigated.
Okay, fine, thank you.
So I think the last thing I wanted to say on this slide is that we're seeing now more and faster prosecutions, particularly in the VAT space. Just this week, I've seen a case where a disclosure was made in relation to VAT irregularity, and very quickly that proceeded into a criminal investigation. HMRC is under pressure to deliver quite significant increases in tax prosecutions, and I think my message there, loud and clear, is that if clients are in a situation where disclosures need to be made, thinking about a process such as Code of Practice 9 as early as possible is the way to go, because you never can tell how HMRC might react to a disclosure these days, even where you might have been discussing it with them on a civil basis.
So would you recommend COP 9 rather than WDF?
Well, I think WDF is clearly the Worldwide Disclosure Facility for offshore type tax disclosures, but it doesn't include an inherent immunity from prosecution, which the Code of Practice 9 does. So I think the number of WDF registrations is relatively low since it came into being as the successor to the Liechtenstein Disclosure Facility. So COP 9 is not always the way to go, but in terms of immunity from prosecution, it is really the only process which potentially offers that.
Okay, thank you. A couple of practical points. One for George. Can Customs and Excise, HMRC VAT Office, refuse an independent review of an investigation case carried out by one of their officers unless additional information is provided to them?
Well, my understanding is that the right to statutory review is exactly that, it's statutory, so the revenue can't refuse.
Okay, fine, thank you.
And my last comment really is that HMRC, Kevin, will do well to observe these very wise words. Technology is a useful servant. We're not kinking it. We realise that progress is progress, and technology is a very large part of that. But it can be a very dangerous master. So I think, we see quite a lot of pain at the moment with clients and with investigations through the use of technology, and it's important that practitioners, professionals, tax advisors, etc., constantly feed back to HMRC where they think they're going wrong with the use of technology.
Okay, thank you. And one last one for you. What sort of things we've been asked will increase the risk of prosecution? What sort of things should the agents be looking for?
Okay, so a good place to start, I always think, is looking on the revenue website at the HMRC criminal prosecution policy, which is selective, and there are some features in there that you need to look out for. If it's, for example, a client or an individual that's a professional, that increases the risk. They love prosecuting accountants, lawyers, and other professionals, medical professionals, etc. So that is an aggravating factor. If there's any element of concealment, VAT seems to be a bit of a hot topic for prosecutions at the moment, where people have been deliberately not paying or not putting invoices through their books. But yeah, any falsification, any concealment naturally increases the risk of prosecution.
Okay, that's great. Thank you.
Okay.
Okay, great. Well, thank you very much, Dominic. Thank you all for listening in today. That was a very thought-provoking webinar we've had. So thank you, Dominic, again.
Thank you.
Thank you all for listening in. As I mentioned at the beginning, this is one of a number of seminars, webinars that we've been doing throughout the year for our member firms. If you have any questions, please feel free to make contact there for any of the technical items. Similarly, if anybody has any queries concerning or anything they want to discuss with PFP or its products and services, please do get in touch. Meanwhile, we hope to speak to you again in the new year and wish you a good holiday. Bye-bye.
Bye-bye.